Hi everyone, it's Paul Flynn here from Proactive Tax, welcoming you to our webinar flagging up a great opportunity to roll out a new capital gains tax property review service in light of the legislation which was announced in the Finance Act 2019 and which fully came into play back in April 2020. Before I do so, it would be rude of me not to tell you a little bit about Proactive Tax. We at Proactive Tax help accountants around the UK, from Land's End to John O'Groats, across to Anglesey and the beautiful country of Northern Ireland, to enhance their tax profile within their own client base and the local community through a whole range of ways. And all for a subscription starting from as low as £97 plus VAT per month. And there's no tie-in. At the £97 level, you would have access to a range of CPD certificated webinars, which cover a range of tax issues, some put together by myself or my colleague Ian Patterson, and some by our tax specialists, who cover the full gamut of taxes you can possibly think of. You can call upon these specialists to offer PI covered advice or to implement the tax work itself. Some of our members white label that out to their client and prospect base, whilst others allow the specialist to engage direct with that client. In the latter case, once the specialist has been paid, the members earn a payaway off the back of the work done. We strongly advocate that our members follow the guidelines laid down by the professional bodies in respect of receiving that commission. Again, at the £97 per month level, members can access a whole range of resources, such as the CGT property resource, which I'll cover off during the course of this webinar, plus others such as the company car review, which looks across up to 6 years whether to purchase or lease the car through the company or to do so personally, as well as comparing one car against another car. There is ARC, Ask the Right Questions resource, which aims to turn your client into a 4-dimensional one, burning up a history of not only the client or their business, but also their family, their hopes, aspirations and goals, personally and business-wise, their assets and liabilities, their IHT position, as well as a tool to gauge whether they're on course to reach their goals. There is a crypto hub, which looks behind crypto trading, which is all the rage at the moment, as well as the pension allowance review, which is great if you're looking at year-end planning. However, if PAT membership is not right for you, you can still access some of our other resources. We have many non-PAT members who are using our payroll service to white label out to their clients and promote to their prospect base, enabling them to focus their time and energy on their clients' businesses whilst also profiting from a hassle-free payroll service. The cost of the accountant is £2.45 per payslip, minimum £5.40 per business, plus on top of that £1.35 per employee for auto-enrolment. With no setup costs and no end-of-year costs. You charge what you like to the client, subject of course to their approval. There are a number of non-proactive tax members who roll out and personalise our Pay Less Tax newsletter, which goes out 5 times a year, along with the internal help sheet for the accountants themselves to refer to. Please do not hesitate to contact me at the end of the webinar if either the newsletter or the payroll service is of interest to you. I'm delighted to say we have our tax pricing software, Effective Price, which is also available to non-proactive tax members through our Effective Price website, starting at £26 plus VAT per month. To access Effective Price software, simply go to the website www.effectiveprice.co.uk and register to start using it. On top of that, we have also just rolled out our flexible tax diagnostic software, which has a monthly subscription of only £78 plus VAT per month. This can be accessed via our Tax Boost website, www.taxboost.co.uk. Again, if you want to look at either Effective Price or Tax Boost, simply contact me at the end of this webinar and I'll be happy to show you. Right, let's get back to why you are watching this webinar. Before we look at the golden opportunity here for you to add considerable value to clients and prospects alike, I think we should cover off what are the main principles of what I call the 30-day CGT return requirement, which came into play, as I said, from the 6th of April 2020 for UK resident taxpayers as regards the disposal of UK residential properties. It, of course, has been around for non-UK resident taxpayers since April 2015 in various formats. The legislation for this new CGT regime can be found in the Finance Act 2019, Schedule 2. I initially look at it as though it's split into two, one in respect of the requirements to comply for the non-UK resident taxpayers, and the other as regards UK resident taxpayers. Some requirements naturally overlap. From 6th of April 2020, non-UK resident taxpayers who dispose of either UK residential or commercial property or an interest in UK land, whether they do so directly or indirectly, must submit a CGT return within 30 days of the completion date, irrespective of whether they make a gain or a loss on that disposal. They must also pay over the capital gains tax within that 30-day period. This is a departure from previous years where the CGT return had to be completed, but the tax did not necessarily have to be paid over in that time frame if the non-UK resident taxpayer completed a UK self-assessment tax return. As regards a UK resident taxpayer, from 6th of April 2020, a CGT return must be completed within 30 days of completion of a disposal only of a UK residential property, and a reasonable estimate of the capital gains tax paid over within that 30-day period as well. Who could be caught by these rules? It is wide-ranging, from individuals, civil partnerships, married couples, partnerships, LLPs, personal representatives of deceased estates, and trusts, be it UK resident or non-UK resident. However, note that disposals by companies, charities, pension schemes, and most collective investment schemes are not caught by these rules. As regards UK resident taxpayers, there is also no requirement to complete the 30-day CGT return if there's no taxable gain, because it is covered by, say, principal private residence relief or the capital gains tax annual exemption. Likewise, if it is a no gain, no loss transfer, such as one between married couples or civil partnerships, then no 30-day CGT return is required. The same can be said if the property disposal results in a loss, or the client has capital losses brought forward from earlier years, or losses have arisen during the tax year from other disposals up to the completion date of the sale of the residential property, which wipes out the gain. The grant of release for no premium to a person not connected with the grantor under a bargain made at arm's length. Again, in that case, there is no requirement to complete the CGT return. Only the residential gain needs to go on. So, for example, if the UK resident taxpayer was disposing of a property consisting of a shop with a flat above, then only the gain regarding the flat would need to be reflected on the return. Note, I reiterate, this is in respect of UK resident taxpayers and only as regards the 30-day CGT return rule. They will still need to disclose the disposal on their self-assessment return. In the case of both UK and non-UK resident taxpayers, a disposal of overseas property does not need to comply with the 30-day CGT requirements. If the client does not comply with the rules, then there are potentially two sets of penalties which can arise, plus interest as well. They work on similar lines to the way the self-assessment penalty and interest regime works. The first penalty relates to the failure to submit the CGT return on time. The second penalty is very much tied in with the self-assessment regime and relates to the late payment of the tax. If two or more persons dispose of the property, then, dependent upon their individual circumstances, you may find that you have to complete a CGT return for each one of them. Likewise, if a client disposes of more than one property, which triggers off a chargeable gain in a given tax year, then they will normally have to complete a CGT return each time. The only time that will not be required is if the properties have exactly the same completion date, in which case one CGT return would suffice. It is important to note that the 30 days CGT return countdown does not start when contracts are exchanged on the property, which is, for tax purposes, the usual CGT trigger point. It is, in fact, the completion date, which is the date title is conveyed. When calculating the gain on the disposal, there will be difficulty in perhaps obtaining all the information to provide a bang-on accurate CGT calculation. including in knowing exactly what rate of CGT which should be applied to the gain, i.e. 18% or 28%, on the grounds that the tax year may still have some time to run. And therefore, you'll be guessing what the person's likely total income will be for that year. With that in mind, you are required at the time to make a reasonable estimate of the capital gains tax to be paid over. You may need to justify that reasonable estimate, as HMRC will have the right to review the documentation and calculation at a later date if they so wish. It is therefore important that records are kept to substantiate your estimate and to retain them, I would say, for at least 6 years, just to play safe. You can amend the CGT return up to as late as the 31st of January following the normal filing date for a self-assessment return. However, you can only amend it in respect to circumstances which occurred prior to the original completion date. As I mentioned earlier, the CGT disposal should also be reflected on the client's normal self-assessment return. So if an SA return has subsequently been submitted to HMRC, then it's that SA return which has to be amended, not the 30-day return. Likewise, if HMRC have issued an SA return and the submission date has passed, then again, any revised calculation must be shown on the self-assessment return for when it is finally sent in, rather than amending the 30-day return. When preparing the capital gains tax calculation, if this is the first property disposal in the year, then you apply the capital gains tax annual exemption against the disposal, even if there has been a disposal of other assets, such as shares, for example, earlier on in the tax year. As I touched upon earlier, you can bring forward any capital losses from earlier tax years, as well as capital losses from disposals of other assets which arose during the course of the year up to the property completion date. Based upon the information to hand at the time, you'll have to estimate the applicable CGT rate. Once the CGT return is completed and submitted, HMRC issue a reference number against which the client makes a payment across. This payment is then linked up with the client's self-assessment records. When the complete details, both in respect to the client's CGT calculation itself and their overall income position for the year in question, is known, either the 30-day CGT return or, as is more likely, the self-assessment return reports on the final CGT position. There are numerous things to consider when putting together a CGT property calculation. Such as what, I hear you shout? Well, in the case of non-resident UK taxpayers selling a residential property, you could be looking at a minimum of 3 CGT calculations if that property was owned pre-April 2015. And as regards commercial property or land owned pre-April 2019, a minimum of 2 calculations. Mixed-use property sales owned pre-April 2015, then those calculations can ratchet up to 5 as a minimum. If the non-resident owns 25% or more shares in a company, of which 75% or more of the value of the underlying assets in the company consists of an interest in UK property or land, and sells his or her shares, that disposal is also caught by the 30-day CGT return rules. For UK resident taxpayers disposing of residential property, there's a whole raft of things to consider. Easier if they are your existing client, as you may know their ownership history, but more problematic if they are new clients coming to you off the back of trying to comply with this new capital gains tax regime. I'll run through a brainstorm I did for this webinar of some things that should be thought of if you're wanting to be professional about it when putting together a calculation and completing the 30-day capital gains tax return. When I talk about a client here, that could be an individual or trust or personal representative of a deceased estate. You can tell I've brainstormed it as it is in no particular order of importance or value. Here goes. Started. Was the client truly UK resident at the time of the disposal? Was the property acquired before the 31st of March 1982? Was it inherited? Was the property gifted to the client? What was the market value at the time? Was gift holdover relief claimed by the transferor at the time of the gift? Did the client roll over again when acquiring the property? For example, he's used it as a furnished holiday let. What are the incidental costs of acquisition? What are the enhancement costs? Did they actually occupy the property with a degree of permanency, such that it could be called a residence? Was it their main residence throughout? If not, what was the periods of absences and the reason for them? Did they have more than one residence? If so, is there a PPR election in place? If not, is the other residence one which the client rents? In which case, could Section 222, subsection 5A of the Capital Gains Tax Act 1992 save the day? Has the client been in job-related accommodation, but there was an intention to occupy this property which he sold? Did he or she ever occupy it? If not, when did the intention to do so come to an end? Is the person or their spouse or civil partner who is selling the property disabled, or is going to or has already gone to a care home? Are the clients a married couple or civil partnership? If so, did one spouse own the property previously and transfer a share or all of it to the other spouse? If so, when? Whilst it was their main residence? After they left the property but before the 6th of April 2020? Or after they left the property but the transfer took place after the 5th of April 2020? Is the property being sold or furnished holiday let? Has the furnished holiday let business been structured in a way that the disposal will count for entrepreneurs relief, or business asset disposal relief as it likes to be called nowadays? Is the property and land it is sat on more than half a hectare? What was the excess of half a hectare used for? Was the whole of the property used for residential purposes, or was it of mixed use? Is this disposal part of a divorce settlement? If the trust is selling the property, what does the trust deed say regarding the rights of beneficiaries to occupy the property? Did any beneficiaries occupy it? Was the property settled into the trust, and did the settlor hold over the gain into the trust? Did the client receive the property from a trust, and was that gain held over at the time? Was the property occupied by a dependent relative? Could the personal representatives of the deceased claim legatees relief? Could the gain be covered by the home purchasers agreement relief or by the adult placement carers relief? I'm sure that this is not a definitive list, and I accept that some of them will not occur on a regular basis, but I emphasise, if either you don't fully know the ownership history of your client, and especially if it's a prospect walking through the door, you should not be assuming anything. All those questions could potentially come into play, and depending upon the answers to those questions, it could have a far-reaching impact upon the tax liability for that particular client. So that's the premise. The background to what I see is a fantastic opportunity for your firm. But what is this wonderful opportunity? Or should I say opportunities, to be more accurate? To make it work and to minimise the effort and maximise the gain in bringing this opportunity to its full potential, then you should set up a CGT property review service. Get the structure in place, and it'll be easy for you to provide a consistent service. We have set up a CGT property review service for our members, from the cradle to the grave, as I like to call it. But there's no reason why you can't do this yourself and reap the benefits from it whilst ensuring you're providing value to those relevant clients. I will show you aspects of ours, and you can see if that is something you may want to replicate. I think first and foremost is draw up a checklist to plan out the decisions and actions you need to consider and, where relevant, take. You then need to consider to whom are you going to roll this service out to. Surely the minimum is to your existing client base, if only to protect that client base from other accountants. But why not your prospect base as well? Does your firm want to approach those third parties to offer that service through them? That is a starting point decision for you to make. Naturally, I personally would be going down all three routes, but each person and each firm is different. Once that's decided, the next question to answer is what sort of service will you be offering? Are you comfortable with offering the compliance service only, or the tax planning service? Or do you feel that you can roll out a combination of the two? Do you want to offer a different service depending upon whom you're dealing with, either clients, prospects direct, or prospects through third parties? The next decision to be taken is how are you going to price the service or services you're offering? On an ad hoc basis, based upon the value of the property or land, the tax saved through planning, or fixed price, or some other method. Maybe it depends upon the service you're rolling out, resulting in a flexible approach to pricing, depending upon the particular circumstances. In our case, we have created two pricing models for our members to use. One going down the separate compliance and planning route, and the other is where you're combining the two services together. The pricing model in each case has been broken down into three pricing levels. Based upon our experience of the CGT implications, we have endeavoured to identify the key areas and therefore the likely pricing points. As I say, these are suggestions. You can easily develop your own pricing policy. Okay, I've decided upon the pricing policy, and now I need to start taking action. Firstly, I need to therefore set up my agent's online authority in advance on taking on board the client compliance work. This is different to the HMRC online service account I presently have. Dealing with my clients first, I need to surely make them aware of the changes in the CGT legislation, which came into effect from April 2020, pointing out the penalty situation for non-compliance, but also pointing out that I can provide the compliance service, and if they want added value, to speak to me pre and post sale to see if tax planning can be done. I should be sending that out not only to my UK resident clients, but also my non-UK resident clients as well. If there are clients who I'm aware of who might be contemplating selling their property in the near future, I may consider sending out a different email or letter for warning them of the CGT changes and the services that I offer. Given the very tight turnaround time of 30 days from completion, I would also contact those clients I believe have property or land in the case of those non-resident clients, and guide them firstly through the HMRC setting up of their capital gains tax UK property account, and to provide authorisation for me, the accountant, to deal with the compliance aspect through your agent's online authority. With existing clients, you may want to start collecting data regarding the properties and land in readiness for any subsequent sale, perhaps when completing tax returns or when you have the year-end planning meetings with them. This will save you a lot of time if the property is subsequently sold. It may also give you the chance to offer planning opportunities as the information comes in. What about prospects to target, i.e. those not through third-party contact? What actions would I take? I might do a combination of things, such as create an awareness of the CGT changes and the services I can offer. In no order of priority, I would send out awareness emails and also send out personalised flyers. I would have videos for my social media and website. I would provide my local newspaper with a news article pointing out the compliance issues, with the aim it points the readers back to me. Some of our members have set up property investor forums separate to their accountancy business, and I'm sure they will use that vehicle to promote the awareness and the service they can provide. You could do something similar. Have a personalised pricing brochure which could be sent out to those prospects. If the prospects are interested, consider an online meeting, and then if the prospect engages with you, do then get them to register on the HMRC CGT online account if they have not already done so, and talk them through the process of authorising you. You haven't had the good fortune of them being existing clients, so your understanding of them and the property or land ownership history is nil. So get out the fact-finding information as soon as the engagement takes place. It's the turnaround either for the compliance work or the tax planning review, if the new client takes that service up, might be very tight. This is also a fantastic opportunity to work with other third parties, a chance to create new relationships or strengthen existing ones with those professionals who will perhaps be the first port of call for the individual or individuals who are contemplating selling the property. Those third parties might be estate agents, mortgage advisors, banks or conveyancing solicitors. One of the main reasons why the 30-day CGT return did not come into existence for UK resident clients until now was that the Law Society and their members, i.e. the conveyancing solicitors, kicked up such a stink about it, saying it was outside their remit and technical domain, that it would be a compliance nightmare. You, as accountants, though, will have the technical knowledge and experience to be able to deliver the property review, compliance and tax planning services through these third parties. Again, by providing a great CGT review service, you can effectively market yourself to these new clients whilst earning from it. The delivery of a quality service in this respect may lead to those third-party clients becoming full clients of your own, buying other services from you. Again, I reiterate, these individuals are likely to be high net worth ones on the basis that they own a property or properties outside their main residence in many cases. These are the people you want to get in front of. As a side issue, you may find that this cements your relationship with those third parties, which may trigger up other opportunities to work together, which is mutually benefit to all parties, including, importantly, the client. Build up a brief of those third parties to target and the approach you wish to adopt in approaching them, be it conveyancing solicitors, estate agents, lenders, or existing property forums. I would draw up a list of names I want to approach. I would give them a call or suggest a conference call or even a meeting if social distancing can be maintained safely and everyone is comfortable with it. Don't assume they understand the implication of the CGT changes, so make them aware of it. Discuss the sort of referrals you'd like to have and how best that might be delivered by that third party. Discuss the arrangement of how best it can suit both you and them, as there has to be mutual benefit, plus benefits to the client themselves. The key is to keep the message simple and pricing simple, so you may wish to set up fixed pricing for this service you provide through other professionals. Perhaps provide them with a professional pack of awareness videos for the third parties to use. Flyers they could send out or hand out, pricing information which makes them easier to bring the CGT issue to the table for effectively their clients. You may wish to personalise the pack before passing it across to them, in my opinion. Set up regular contact with the third parties to keep the relationship warm and gauge whether any aspects of it needs tweaking and to find out what is and what is not working. Then it is a matter of ensuring that the service is of top quality, which will enable you to wow your existing client base, add value to them, and retain the new clients pulled from your own marketing, or the arrangement with third parties, which should generate additional services, compliance or otherwise, to be rolled out to them going forward. Collating the information is one thing, and applying it correctly is another. You may have that, I am sure, all in-house, but if not, look at the potential pitfalls and opportunities. And if you have your own team, create your own in-house briefing notes to cover off the processes and the issues, the tax relief and the planning opportunities pre and post sale, which might impact upon your client's situation. Even put together a checklist so that points which need to be covered are not missed. It would be a good reference point without having to reinvent the wheel at a point when time may be of the essence. If you have time, perhaps even consider putting together a spreadsheet calculator to help you with the CGT calculations. Again, in the long run, that may save you some time. We have put this resource together for all our Proactive Tax members to use, which I suspect they'll be drawing upon for many years to come, as I don't think the 30-day CGT rule will go away for quite some time. But you have this within your armoury to do something similar. Don't ignore it, as there will be accountants out there in your area offering such a service. One of our members recently picked up 4 new clients in the last week alone from doing so. And yet we are still in the relatively early throes of this new CGT regime. HMRC brought out a report in May 2021 which stated that in the period from April 2020 to the beginning of January 2021, around 50,000 30-day CGT returns were completed, and yet just over a third were submitted late, resulting in just over £1.2 million worth of penalties being collected. Bearing in mind the first few months covered the first COVID lockdown, and some clients still won't yet have told their accountants about CGT property disposals during the last tax year, that is quite a worrying statistic. And it shouts loudly that taxpayers still aren't aware of the legislation. Have you at least made your clients aware of it? Get in there first before somebody else does, or potentially lose your client. I had a lady contact me through a friend who was ditching her accountant, and she got hit with penalties following the disposal of 2 properties during the 2021 tax year for exactly those reasons. I've recommended one of our members to take over dealing with her and her husband's tax affairs. Just to reiterate that if you did become a Proactive Tax member at £97 plus VAT per month, you would get the CGT Property Review resource as part and parcel of your membership, along with a multitude of other benefits. If you already think Proactive Tax itself might be right for you, then simply click on the subscribe button on the web page, complete your details, select your membership level, and then fill in your bank details. If you want to discuss it further before making a decision on membership, or you want to look at effective price, tax boost, or payroll services, or pay less tax, which are not tied to the PAT membership, then please do not hesitate to contact me on paul.flynn@proactivetax.co.uk or info@proactivetax.co.uk, or phone me on 01246 488 200, and I will be happy to set up a no obligation conference call. I do hope you found this webinar of some value. Thanks for listening and take care.